we do think if we move into this boom, that will dissipate and many more parts of the market are going to benefit. That has started happening this year. And we think that would accelerate into next year. In our bullish case for Bitcoin, we're known for $1.5 million. We think that per coin, we think that stablecoins are probably going to cut that by roughly $300,000. So 1.2 million would more likely be our bull case now.
Cathie Wood begins by addressing one of the most persistent failures in retail investing: emotional decision-making. She notes that in periods of intense volatility, like the tariff-driven turmoil of April, investors behave predictably and destructively. They sell into fear, locking in losses at the bottom, and they cling to winners at euphoric tops, afraid to take profits. The real threat isn't volatility itself, it's the ease with which constant account checking triggers fear and greed. Portfolio values now update minute by minute. This accelerates emotional reactions, pushing investors toward impulsive selling during downturns and an unhealthy attachment to overextended gains near peaks.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The saddest one for me to see is during a period of extreme volatility, like April when we had the tariff turmoil.
Yes.
We see a lot of investors selling and they create the lows, the emotion, using emotions as opposed to averaging in when times look tough and taking profits, taking profits off the top when, these companies seem like they can do nothing wrong. Both of those extremes you should use to your advantage as investors. So I think letting emotion get the better and especially if investors are looking at their accounts, I used to say daily, but now you can say minute by minute with some of these services. That can create an emotional reaction both ways. There's the joy of the ride on the way up and they don't want to let go. Take profits. There's nothing wrong with that. The feelings of despair when the market seems to be crashing and you see a lot of your hard-earned work wiped out. Selling at the low is that creates seller's remorse, which you live with for a long time thereafter. The only way that our thesis on Bitcoin specifically has changed is because of stablecoins. So we thought that in emerging markets, that the insurance policies that citizens of other countries that were not managed well, their insurance policies we thought would be in the form of Bitcoin, because anyone hooked up to the internet can buy Bitcoin, and really nobody can prevent it except maybe in China. I know there are some prohibitions there. And some other countries. Well, stable coins have come along and backed by the dollar effectively. They're backed by US treasuries. Tether, in addition to treasuries, is backed by gold and Bitcoin as well. And it seems as though stable coins are usurping one of the roles we expected from Bitcoin. So in our bullish case for Bitcoin, we're known for $1.5 million. We think that per coin, we think that stable coins are probably going to cut that by roughly $300,000. So 1.2 million would more likely be our bull case now. But in every other way, we have not changed our point of view. We think Bitcoin is really it represents a new global monetary system. And it's rules-based. It takes out human decision-making. It drives me crazy to see the Fed, Chairman Powell, or any one of the governors out there talking and causing all kinds of chaos. In markets. It's ridiculous. It's ridiculous. Mathematically metered to go to 21 million Bitcoin. We're approaching 20 million as institutions are entering. So that's, there's not a lot of supply left. And we think institutions have barely tipped their toes into Bitcoin. So this is an important new asset class. So institutions are vitally interested in any asset that has a low correlation with all of the other assets in which they're invested. So Bitcoin's the monetary system. Ethereum has some monetary aspects to it as well. We can tell from its valuation. But it is also the engine of DeFi, decentralized finance, or as others would call it, the internet financial system, because that's all really that we're talking about here. We've introduced a layer to the internet with native digital currencies that did not exist before. And that's because in the early days of the internet, late 80s, early 90s, as developers were evolving the internet, they had no clue that financial services and commerce would take place over the internet. And so we've been using all of these, workarounds, Visa, MasterCard, and which include all of these fees that are going to go down fairly dramatically as we move towards this native ecosystem. And then more broadly, this applies to the monetary system, to DeFi, but to all digital assets. For the first time with blockchain technology, we have property rights, digital property rights, which we did not have before. Immutable digital property rights. The fastest way to pull people and countries out of poverty is with immutable property rights. So we've got a whole new economy brewing in the digital world where ownership now is possible in the digital world. And of course, many people think of NFTs, but it goes well beyond that. Real world assets in the DeFi space are another good example of that. So there's a lot of capital chasing just a few ideas right now. We do think if we move into this boom, that will dissipate and many more parts of the market are going to benefit. That has started happening this year. And we think that would accelerate into next year if we're right on the economic boom.
Wood notes that today's market shows extreme concentration, with significant capital chasing only a handful of themes. However, in an innovation-driven economic boom, she expects this narrow leadership to broaden substantially. Early signs of this rotation began this year, and she anticipates acceleration as multiple innovation platforms begin converging. AI, robotics, energy storage, genomics, and blockchain, her broader macro thesis centers on a major shift in U.S. investment strategy. For decades, markets have moved toward passive indexing. Benchmark inclusion drives capital flows, and active managers rely heavily on index composition. ARC's research indicates that disruptive innovators often create 4 years of alpha before entering major benchmarks. Tesla is the prime example.
For the last 30 years, the market has been moving towards passive strategies or benchmark sensitive. After the tech and telecom crash or bust, and even more so after 08-09, many investors who used to be active and who did not use benchmarks as a screen for their own ideas, they used their own research, which is what we do now. They've moved towards using these big broad-based benchmarks as their guides. If we're right, and these 5 innovation platforms evolve, converge, and create a deflation in a good sense of the word, environment, then that is going to put at risk the traditional world order that is dominating those benchmarks. Now, I will say it's been interesting. The S&P 500 in the last year put 4 stocks that were in our top 10 in the S&P 500. I found that interesting, but they don't put them in at 5 to 10% positions like we do when we have real confidence in a name. They put them in at 10 to 20 basis points. They're really not going to move the needle. And then they let the stock's performance and the revenue growth dictate what percent it becomes of the benchmark as it outpaces other companies. So we think our chief risk officer has done a study of our portfolios and concluded, this is all preliminary, I should say, concluded that we get into stocks about 4 years before they enter benchmarks. Well, there's a huge amount of alpha if you measure us relative to benchmarks. There's a huge amount of alpha we generate before these stocks get into benchmarks. And Tesla is the perfect case in point. I think it entered the S&P when it was a $500 billion market cap. Okay, so there was a lot of performance from the time we got in, which was essentially when it IPO'd, when we were at our last firm. But immediately in 2014, when I founded ARK, Tesla went into the portfolio. There was a lot of alpha generation between that moment in time, and I think it was late 21 or when it got into the benchmarks. What we expect, now this is from the US, but it'll propagate throughout the world. We believe that while the unemployment rate is going up now, and unemployment's a lagging indicator, we believe we've moved from a rolling recession to now we're in a rolling recovery. We're beginning to see signs of life in housing, even with rates starting to come down. But next year, we think we're going to be in a full-blown economic boom in the United States. And the reason for that is the tax package that passed on July 4th. Because the headlines have been screaming tariffs, 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 I think President Trump is a master of distraction. What people don't realize is in the tax package were depreciation schedules that are going to take the U.S. corporate tax rate down to 10% for the next 3 years. And that will be the lowest in the world. And we think that's going to create a foreign direct investment boom, a manufacturing boom, because manufacturing structures are in there, an equipment boom. And it's all going to be part of this AI related boom, AI, including the power and energy to power up these data centers. So I think I think it's going to be much more pervasive than that as well. AI has been powering capital spending, but the rest of capital spending has been falling. We think that's going to turn around quite significantly. So I don't think that's expected. I think a lot of people are worried that unemployment rate's going up, and we're going to continue to slide here, one sector after another, because the manufacturing sector has been negative. It's been falling for 3 years in the United States. Many people do not understand that. So we think that's going to turn around fairly dramatically. In terms of the other one, that's a harder one, I would say. If it happens, oh my goodness. Well, did you mean good or bad?
Either direction.
That is a really hard. Well, I'll tell you what would be very unexpected from our point of view. I mean, most unexpected, but we're hearing little breakthroughs, Google and others. we think quantum computing is not going to commercialize until the late 30s.
Okay.
But we're seeing all kinds of evidence, little breakthroughs here and there, Google, IBM, and others. But there's another one that I think I'll choose instead. I won't choose that one because it just seems so far-fetched. I don't think it'll commercialize, has a shot even next year. But there are people out there who are saying that data centers, which, you know, some are the size of Manhattan, that's New York City, right?
Yeah.
There are some technologies out there that could shrink the size of data centers enormously. And this is the history of technology. You know, you start out massive, think supercomputers, and we end up with little computers in our hands.
Exactly.
I don't think it will happen very quickly. However, just the prospect that there's a new way of solving this problem could put a lot of a halt to the massive amount of capital moving into that space. Just wait a minute, is there a disruption to this disruption? In other words, these big data centers, that actually could be. So you don't need it to happen next year. You need someone or a group of investors to say, wait a minute, if this happens, we're investing way too much in this space right now. So that would be one.
She argues will be a foreign direct investment surge, a manufacturing renaissance, and an equipment boom tied heavily to AI infrastructure and power generation. This shift marks the transition from a rolling recession to what she calls a rolling recovery, eventually culminating in a full-scale economic boom. When asked about unexpected risks or surprises, Wood points to an underappreciated technological wildcard, the potential displacement of massive data centers. Some experimental technologies suggest a path to shrinking data center footprint dramatically. Even if commercialization is far away, the mere possibility of disruptive efficiency could cause investors to hesitate in funding giant AI buildouts. Just as supercomputers shrank into smartphones, data centers might follow a similar trajectory. If investors perceive a credible threat to the current hyperscale model, capital allocation across the AI ecosystem could shift abruptly.